Property investment seems like a pretty straightforward thing to do, and for the most part it actually is. However, there are a few hidden costs that new investors may overlook, which could end up costing you money rather than giving you an impressive return. Hi, my name is Justin Goldie, one of the directors here at Goldson Homes. We're a property company specialising in the property management, maintenance and sourcing of properties here in the south of the UK. Now in today's video we're going to be going over the 5 hidden costs that new property investors sometimes overlook when they're getting into property. When most people think of property investment, it sometimes goes along the line of this. You buy a property, say for £100,000, you get a new lick of paint on the property, maybe some new carpets, any necessary works, or if the property's brand new property, you get the tenant straight in. So you'll hand the property over to the lettings agent and then wait for that 850, maybe to a couple grand to hit your bank account every month. Now, depending on what strategy you're using, this is probably the basic framework for what you will be expecting. However, along the lines, there may be some unexpected costs that come up. So before you actually purchase a property, it's wise to actually factor in these costs to make sure that property investment or the property that you will be purchasing is actually worthwhile and will actually be making you a return rather than costing you money every month. The first ones will be purchasing costs. Now, when you do purchase a property, there are other costs that come into play besides the actual purchase price of the property. But most of these are actually common knowledge, such as things like your stamp duty. So here is a list of the current stamp duty land tax rates. These will be going up on the 1st of April 2025, so do bear that in mind. We have covered the rates, well, the new rates that will be coming into play on the 1st of April. That is done in a separate YouTube video, so you can find that on our YouTube channel. Another purchasing cost that you'll probably know about is your solicitors and brokers fees. These are charged by the solicitors and the brokers for their services when you're purchasing the property. Another common fee is the survey fee. Whatever property you're buying in the UK, as long as it's not a new build, I would recommend getting a survey done, just to give you that peace of mind knowing that the property is structurally sound and is not going to fall over anytime soon. So those 3 costs are the most common ones that you will actually know about when you're purchasing a property. Now there are 2 more that I think you should also factor into your calculations that are particularly important but are sometimes overlooked. So the first one is mortgage product fees. So this is different from the actual broker fee. This is something that the lender will be charging you, and they will either charge you a set rate, so maybe a couple grand just for the actual mortgage for the product fee, or they'll charge you a set percentage of how much you are borrowing. So you need to factor that in because it can be a few £1,000s. The next cost is auction fees. So if you are purchasing a property at auction, you might actually not know that the auctioneers will charge another fee. So you must factor this in. Sometimes this can be up to £5,000, £6,000. So if you're purchasing a property for £100,000, that can be up to 5-6%, which might come out of your budget if you have not factored that in. So in April 2017, the government introduced Section 24. Now, prior to this new legislation that came in, you were able to deduct the interest payments from your mortgage from your rental income from the property. This was when you were working out your tax bill at the end of the year. Now, you were able to do so whether the property was in your personal name or in a limited company. But following this legislation, you were only able to do it when it was in a limited company. So because of this, a lot of investors in recent times have actually started purchasing their properties and building their portfolios in limited companies. Now, although this will reduce your tax bill, it does actually bring up some more costs. So that is the second hidden cost within property investment that may be overlooked, and that is the running costs of a limited company. So what are some of the fees of running a limited company in the UK? Well, to start with, when you're actually setting up the company, you have to pay an incorporation fee to a company's house, and this is £50. Then following that, every single year you have to file a confirmation statement, which will cost you £34. Additionally, you'll have to pay accounting fees. Now, if you can do this yourself, you can save on this fee. However, getting an accountant to do it, especially if you have a much bigger portfolio, it will end up costing you a bit more. So for a smaller property portfolio of maybe 2 to 3 houses, you could expect to pay £300 for the year. A larger property portfolio with a lot more expenses and maybe a few people working for you, you may end up paying an accountant to work for you part-time, which will end up costing you quite a bit. So bear that in mind. So within any business that you're running, there will be regulation, and property investment is no different. However, staying up to date with these regulations and making sure that you are compliant with them can cost you a bit. And this is something that a lot of investors don't actually think about when they're thinking about getting a property. So this is the actual running costs of becoming compliant with the regulations. So the first one would be your gas safe certificate. So every year, if you have a property that has a gas appliance in, so a gas boiler, maybe a gas cooker and hob, you will need to have a gas safety check done on these appliances and the pipework. Now, what we'll have to do is a gas safe engineer will have to come out and inspect the appliances. This can vary depending on where you are in the UK and how many appliances you have, but you can expect to pay anywhere between £90 to £120 to have this done. The next thing is your EICR, or Electrical Installation Condition Report. Now this needs to be done every 5 years, and you'll need to get an electrician out who's qualified and up to date with the regulations, who can then sign off on the property. What he will need to do is test the entire property, so all the circuits, and make sure that there's no issues that arise. Obviously, any extra remedial works that come up, so if he does find any faults that need to be rectified, this will cost you a bit more. But bearing in mind, this does only need to be done every 5 years. The cost of this can vary a bit, so depending on where you are in the UK, electricians charge different amounts. But I think on average, a smaller, let's say a smaller flat with maybe 15 circuits could cost you around £150 to have it done, whereas a 3-bedroom house or a terraced house, something like that, would cost you around £300 with this similar amount of circuits, just because you'll have to test each and every circuit to the extremities of those circuits, so it can take a fair amount of time. So as most experienced landlords may know, is that your property, before renting it out, will actually have to meet a minimum energy efficiency standard. So how do you actually measure this standard? Well, you have to get an EPC done every 10 years. Now, this is probably one of the cheaper regulations to comply with because it only costs you around £30 to do. Now, of course, if your property doesn't meet those energy efficiency standards and you have to do extra works, that can end up costing you quite a bit. So making sure to check what the last EPC was before purchasing a property to see if there might be any problems arising in the near future. We also don't know, the government might be introducing a higher energy efficiency standard, so you may end up paying a bit more if the property has a lower energy efficiency standard now in 5 years' time when you have to upgrade it. The last regulation cost is only for people who do HMOs, so an HMO licensing fee. This obviously does vary from council to council, so you will need to look on your local authority's website to understand how much it actually costs to have an HMO license. So I know for the area that we're in, it's £987 for an HMO license, and this will last you 5 years. So before you actually purchase any property, I'm sure what you'll be doing is running the figures, especially if it's an investment property, running the figures on the running costs. Now, a lot of the time, if you haven't been experienced in property or haven't worked in property before, you'll forget to put in maintenance costs. And obviously a lot of this maintenance costs are out of your control. Maybe a washing machine packs up, that could end up costing you a couple £100 very, very quickly. Now, of course, there are ways to actually prevent some of the maintenance issues. So as I said before, we do run a company that specialises in the property management, maintenance and sourcing of properties in the UK. But our maintenance division is very good. So we do have a few packages which are preventative maintenance packages. So if you do have a property in the south of the UK and you'd like to learn more about our preventative maintenance packages that we offer, drop a comment below and we will be in touch. So the fifth and final cost that we'll be covering today is not actually something that you'll have to pay, but it is something that could end up costing you quite a bit of money. So for any property investment to work, no matter what strategy you're doing, you will have to have someone in the property or using the property and paying you rental. Whether that's, you're doing service accommodation and you have people staying there on a night-to-night basis, or you're renting out a buy-to-let property, you will have to have someone in there paying you the rental income to make a return. Now, a lot of new investors may take this for granted and won't actually factor that into their calculations. Now, when you do not have someone in the property, this is called a void period. Now, I think the current void period in the UK on average is around 21 days for buy-to-let properties, so it's actually not too bad. But it is something you want to factor in, because if you don't have someone in there paying you the rental income, then you're going to be stuck paying the mortgage. Or if you own the property outright, you've got hundreds and thousands of pounds of your money sitting in a property not producing you an income. So when you actually are calculating if a property is going to be worthwhile actually purchasing as an investment, you want to factor in some void periods. So what we like to do is maybe put a 90% occupancy rate. So that will actually factor in maybe 1 month out of the year when we won't have anyone in. But if we do have someone in, then it's an extra bonus and our returns end up being a bit higher. Okay, so that's it. That is the 5 hidden costs within property investments that are sometimes overlooked by new property investors. So I hope this video has been very valuable and you've taken a lot of information from it. And if you would like to learn a lot more about property investment, we have a monthly newsletter that goes out at the end of every month. So sign up for that. And there's a lot of information in there that could really help you. We also have a lot more on our YouTube channel, so go take a look at that. And don't forget to subscribe, like, and comment for any new videos that you might like to see. And as always, see you later.